Good evening and welcome to Outlook Business Annual Wealth Roundtable, Upper Crest. I have with me today Ashish Gumasta, Managing Director and CEO, Julius Bayer, Rajesh Saluja, CEO and Managing Partner, ASK Wealth Advisors, Atan Kumar Saha, Managing Director and Head of Wealth Management at Deutsche Bank, and Ashish Kehair, Head of Wealth Management at Edelweiss. Besides, I also have with me V. Keshav Dev, Executive Editor at Outlook Business, to moderate this discussion. Gentlemen, it's a pleasure to have all of you today on Upper Crest. Even as of last year, we could not have imagined that we would be doing a roundtable like this over a video call, right? And things have changed. But as far as markets are concerned, it seems to me like nothing has changed. In fact, after the initial jitters in March, from January to March, the markets seem to be in a party mode. Is this some kind of irrational exuberance that is waiting to be squared off, or do you guys think this rally is sustainable? Any one of you can take a shot.
So maybe I could go first.
Sure.
So I think, it's always difficult to, Mahalakshmi, argue that markets will be rational. I don't think I have ever seen market to be rational. It either swings towards pessimism or optimism. And this has been, I think, the shortest possible period where we have seen both the legs.
Right.
And right now, I think we are at a point where, from a valuation perspective, yes, we are, no longer even fair. We are reasonably expensive, and things would settle to, reasonable levels, but there would be a trigger needed, and, with passage of time, anything could happen. But yes, some part of the profit booking should be done by clients, and I think it will settle down to reasonable levels. But you never know. Again, it could swing to pessimism, as I said.
Sure. So you are circumspect.
Yep, that would be the right thing to say.
Sure. Ashish?
So what we are seeing is that there's so much, before Ashish, you came into the call, I was just sharing with them that the world is flush with so much liquidity.
Yeah.
And traditionally, this liquidity went into businesses and economic activity, but a lot of that is now going towards investments. My global team was sharing that almost 36% of the stimulus has moved into savings, out there. So we have similarly in Julius, where we have a situation where clients are all holding 20 to 30% cash on their portfolio. And with interest rates coming down, what we are seeing is that at every dip, there will be there will be money coming in, So globally also, we think US will continue to see markets. That's what our global strategists say that we are positive on US, we are positive on China. India also, we don't see currently, based on our understanding, of 5 to 7% kind of a correction. Of course, you have the risks of a vaccine getting delayed or, something coming out of the blue, right? But right now, as I meet families, I was just sharing with Keshav also that the overnight liquidity still, which RBI is carrying, is very, very significant, out there. And if you see, Mahalakshmi, the money which came was very concentrated. It was in very few stocks, even overseas and even in India. That wealth has become very concentrated. But that trend is changing. So, there was talk of value investing, which was going on even last year when we met for the previous Outlook event. Finally, if you see, value stocks have just finally started doing well. Government of India is pleasantly surprised us by doing a buyback in HPCL, NTPC doing a buyback of shares. So suddenly, for the first time, this value trade is emerging. Now, if you see the PSU basket, a lot of the PSUs are trading at very, in a crude way, you can say it's bankruptcy valuations right out there.
Correct,
So the way we see it, and you saw how the Indian markets was, first the pharma sector rallied, then the consumer sector rallied, then that money went into the IT sector. Now that money has gone into the financial sector. So money, in our sense, will keep rotating. The players will change. That's what is our sense. You may see some more value coming into play. And possibly with Biden coming, our global strategist feels that the value trade may finally take off.
What has Biden got to do with value?
It is the sectors you're supporting, the general, like the Trump was seen as a pro-business, tax-wise, to the tech companies. There were a lot of benefits which are available, out there. Yeah. So that's the sense which is there. Though he has proposed, to bring the tax exemptions down. He's going to tax corporates higher. So generally, I mean, it is supposed to be in a corrective phase. But see, the fundamental problem is that interest rates are zero, right, over there globally. You can borrow money at zero. Even in India, of late, home loans are now available at sub 7% out there. So my sense is that numbers are going to surprise us on the positive side. Unless something extenuating happens, another lockdown comes in, or some such extenuating thing comes up, then that's not in our control. Or the vaccine gets delayed by a couple of months more. But otherwise, things look much more positive. And as Rajesh was saying, we are all born optimists. So in every crisis, we see some opportunity which is there.
Sure. So you are optimistic, primarily because liquidity is plenty and there is money.
No. See, you never invest money. Yeah, you never invest money for liquidity, because liquidity has a funny way it disappears.
So money will keep coming into the markets as and when there are dips or bouts of pessimism.
Yeah, that's the current trend that we are seeing. That at every dip, investors are increasing their asset allocation, both globally and in India also. That's the current trend that we are seeing. But just because there is liquidity, you invest in the capital markets, we don't believe in the trade. And we see a shift coming slightly to the value trade. But are we moving all our clients into value and telling, no, we are not doing that? We still feel that the growth will continue to do well. And of course, globally, our strategist feels that China will do well in the coming years. So we see people now diversifying from US markets to investing in Chinese businesses.
Sure. Atin or Rajesh?
I may come in, and thanks a lot. I just feel what Ashish has said and both the Ashishs have said, it makes sense. Primarily, as we look at it, we are saying it needs to be seen in the backdrop of where we were pre-COVID times, right? Now, pre-COVID times, in the last 6 months prior to that, or 1 year prior to that, we still had issues on economic recovery in India. There are a lot of sectors which were suffering with NBFC crisis, IL&FS crisis. Prior to that, DeMont, RERA, GST, everything had impeded the growth to a large extent in the first year of Modi versus after that. And therefore, the entire results of the structural reforms that were coming in were not being seen in the numbers. So economics-wise and the industry-wise, it was suffering to some extent. And then you had a COVID, because when we appeared last year also, we were very circumspect of this year what would happen, right? But what happened ultimately is it became worse because of COVID reasons. And before COVID, obviously you had, within COVID, again, you have the Templeton crisis. So there was the credit risk, then Templeton. So all this compounded itself and created a lot of issues in the marketplace on the debt. However, as you use the word exuberance, we don't really see that there is exuberance in the market. Because of liquidity reasons, the market is at a certain level. But we don't see client exuberance. Yeah, so that's very clear. Clients are trying to be on the safer side, more on the large cap, fundamentally strong stocks. And if you see the kind of investment that happened from the FIs also, more than 6 billion or so this year, has mainly gone to fewer stocks. If you see the Nifty performance has been minus 3.5 or so, but if you take few stocks, they've really done extremely well, right? Few PMSs have been able to beat, but very few mutual funds have been able to beat this benchmarks. Primarily because it's got selectively gone into fewer stocks. Same way some PMSs have done well. So I think equity market as a whole is still with a P forwards of around 24, 25, which is very rich. It looks on the face of it, but with earnings gradually improving. Now, what's our outlook on the earnings and what's the outlook on the economy as such? If you see IMF, if you see RBI, all the estimates show like the worldwide, it would come down to around 4.5% or so this year. And the next year, it should show a growth of 5 or, approximately that value. So you will almost recover by 2022 globally. If you see India's numbers also, minus 8 to 10%, and then you have a plus 9% or so. So that basically means that by 21 end or 22 mid somewhere, we'll come to the old pre-COVID levels. Having said that, the markets normally rally before or after the trends are already seen in the economics. So you see now more moving towards positivity, primarily because clients are optimistic, because they've always been optimistic even in this crisis, except that they've taken away their own money and moved flight to safety. They've gone into safer products. But in equities, the allocation from our clients haven't gone down. and equities will flow in, like especially on institutional side, you see massive inflows coming in on the equities as there's liquidity globally. So that would be the scenario. The only reason we would say this optimism may not play out is one, the vaccine not gets delayed by 1 or 2 months, it got delayed furthermore, right? It may not come in by the first quarter, it may come in by the third quarter or so. So that, and basically seeing that vaccine coming in and the growth of the how the COVID relapse happens, like in European markets in the US, you're seeing the economy getting affected again because there's lockdown again in the second phase. You will see how India plays it out. For Indian local markets, we need to see, because now again, the COVID numbers have come down, the recovery rates have improved, the death is still at 1.5%, which is not so high rate or so. So if you see those kind of dynamics, if the COVID situation doesn't really deteriorate further and we don't get a relapse again in the next 6 months or so, and by the time you get the vaccine in, then the next question will be whether vaccine spread, the effectiveness of vaccine, and the ability to really stream it out to everyone. So I think there's a lot of things dependent on the COVID result. But if this is stable and positive, you would say optimism from the industry will remain in the marketplace. The market has overrun, but it will remain. So we wouldn't expect a staggering increase in the equity in the next 3 years, but we'll say on the average around 10 to 12 or 12% of returns or so, you could look at the next 3 years in the equity market. So equity markets will still have a risk premium over the debt, and we would advise our clients to stick to the structural asset allocation, which the strategic asset allocation which they've decided on, and continue with it. So our game will be, even in these crisis times, although we went a little more neutral on equities, a little more conservative on equities, we are now neutral on equities. And going forward, I think it can only improve from here, not really decelerate.
Sure. Rajesh, how is two questions also related to this. One is that how important do you think the COVID conversation really is in shaping markets over the next 1 year? And second, how is this liquidity angle really playing out in India, considering that interest rates have come down substantially, and that was seen to be a great trigger for people to look at equities as an alternate investment class. But now that they have, really gone up quite sharply in a very short time period, are people worried, or are they willing to give it a shot? Or what is the sentiment really like?
Yeah, so with regards to the COVID question, whether there is another lockdown or how much time the vaccine takes, very few have the right answer. And there could be still situations of economies starting, stopping, going into lockdown, partially, completely, depending on, each country's own imperatives. But this is like this last 6, 8 months, 10 months is not like a normal recession, where prior problems have to be fixed and overcome. While most market recoveries depend on overcoming some sort of an imbalance or defect in the markets, like what happened, the dot-com mania in the 90s or subprime mortgages in 2008, the current bear market, or I would say not bear market anymore, but the current last 6 months market was primarily due to the clampdown effects of, to slow the spread of COVID-19. So you think of it like the economy like a car that's come to a complete stop. Now, is the car stopped because there's something broken in the engine or the electrical system, and that could take time to repair? Or has the car stopped because you've just taken the pedal, your foot off the pedal? And because if it's the latter, then all you have to do is to put the foot back on the brake and you come back, right? And as even we've started unlocking the economy, and most countries have, you can see all on a fundamental basis, results of companies, all have started to improve. Various factors, the PMI, the electrical consumption, power consumption, so all have started to show an upward trend. So that has, of course, changed the sentiment when it comes to investing. Secondly, liquidity. If you all of us spoke about liquidity, but if you just look at the numbers, it's amazing this time. About $5 to $6 trillion of direct fiscal stimulus has been announced by the top 20 economies. Now, this is close to 7% of 2019 global GDP. And you'll be surprised, the same figure in 2008, when the financial crisis happened, was only about 3.5% of the global GDP at that time. So you're talking about 2.5 times, 3 times the amount of money that got printed in 2008 has got printed this time. Now, what's that going to do? When you have so much of liquidity, you have low interest rates, you are going to see money moving into other asset classes. So equities, gold, technology through private equity or listed space, or even real estate. These are seeing huge inflows. And in equities, then you can't ignore India because our structural story hasn't gone, right? So short-term impact or political impact or economic impact, maybe short-term there'll be some imbalances. But if you still think about 5-10 years, India, China are going to be two big markets. And China and US are going to be two large consuming markets along with India. So money will definitely flow in. And COVID impact, is just a function of when the vaccine comes out or, when things become better. So that may take 6 months or a year. But I think that's been discounted. Today, you have what have the markets assumed? Definitely FY21 is a washout. India is going to degrow 10%, 11% GDP. The world is degrowing. So people have stopped looking at this year. What everyone is looking at is how are the next 2 years going to look? Because there are many companies and businesses that have actually benefited because of COVID, right? Due to COVID, there have been industries that have benefited. There's consolidation within industries where the weaker players have got left out. And you have to also remember in valuations, a big factor is your finance cost. And the way the interest rates have come down, the more 1% drop in interest has a 10% impact on PAT. So of course, going forward, every quarter, you'll see better fundamentals also. So good improving fundamentals and improving economy, huge amount of liquidity and better sentiments is what will keep the market going. It has run up, but if it optically looks as if it's run up because there are 7-8 basic stocks that have gone through the roof and they've contributed, but largely there's still good amount of value left if you look at valuations from a FY22, FY23 perspective. So most of our clients have taken this opportunity. We have been overweight on equities for the last 6 months. We've gone neutral now, but last 6 months we've been overweight and have been staggering and using this opportunity to keep investing in equity. And I don't think that trend is going to go away because many business owners have liquidity. They've saved money. They've not traveled. The businesses haven't required money, and all of that is flowing into now, equities. Irrespective of us thinking it's run up too fast, you still see decent inflows coming into equities.
Ashish, I just want to take off with Rajesh. Now, earlier, 6 months back, we were saying that FY21 is discounted, now FY22. Now we are talking of FY23. So since you are kind of circumspect, so, how are you viewing the whole thing? How long can anyone keep justifying, that let's keep pushing? Now that will be FY24. I mean, how comfortable are you now?
See, FY21 obviously is a unique year. I think once in 100-year situation, you indeed have to write it off. FY22, if things normalize and if we get the vaccine and things start going on, I think things will start normalizing and you will start seeing business activity getting normalized and everything getting normalized. But you will also see then interest rates starting to go up. See, if economy starts doing well, if inflation starts kicking in, then these things will start changing. And as I think Rajesh, Atin, Ashish all pointed out, markets are actually ahead of all of us.
Right.
And once you have an inkling of things changing, you never know how things will get discounted. So our sense always has been that you have to respect valuations. You can't really predict because valuations will teach you that you need to respect them at all periods of time. Last 6 months gave a good opportunity for clients to increase their allocations. I actually think that if we get an opportunity of something going untoward in the economy and markets tanking back again, it's once again a very good opportunity to increase allocation because structurally these things are not going to change. It may take a year, it may take 6 months, you never know. But once, and things have to normalize. It's not the end of the world. So these are once in a lifetime opportunities when you get cheap cheap kind of situations where you can allocate excessive monies, which was there in, let's say, 10, 15, 20 days of March and April, after which it never gave anybody a chance. And
Right.
if you get that kind of a chance again, you increase your allocation substantially. But if it ranges between 12,500, 10,500, we keep shifting our allocations from overweight to underweight. Right now we would be mildly underweight, about 10 odd percent from our strategic asset allocation, since the time we've crossed about 11,700, 11,800 levels. And we also hope that market keeps going up like everybody else. It's good for us, but over time I've just seen you need to respect valuations. You never know where that unknown devil is sitting to come and hit you.
So in that kind of a scenario, where do you see value? I mean, is there any pockets that you see, where you can go and hide, if at all?
Actually, broader markets, the up moves have been really polarized, and broader markets you still have value available, especially in mid and small caps. But you have to have the ability to withstand volatility, because if things go wrong, then they take a significant amount of beating as compared to large caps. But I think that is where the value lies, because most of the large money has gone behind few stocks. So
Right.
at 50p, 60p levels, you don't get value. I am still bullish on IT, I would say, and continue to be, bullish on pharma. Although pharma has had a run up, but it was after a 5-year period of a, lull, that you've seen some pharma run up happening, and IT has been, reasonably doing well. And you've seen IT companies which are extremely conservative and not in that sense extremely bullish. They are coming out in the market and giving a 2-3 year optimistic scenario. You don't see companies like likes of TCS and Accenture normally giving bullish outlook. You've seen these companies talking about 2-3 years of activity happening in 6 months. That gives us significant amount of confidence, at least in these two sectors. And broader market, I think mid and small cap. So I think in the equity side, this is where we would largely see value. Some green shoots in real estate is visible, but still to play out. I think couple of things working out for real estate, like Ashish pointed out, home loans below 7%. I don't know if you remember, last it was 2007. So it's about 13 years now. And if you see the gap between an FD rate and rental yield, residential and rental yields, we've been cribbing for last 10 years, that it's at 2.5%, 3%. Now, decent FD rates are about 4.5%. So the gap between rental and FD and mortgage and income levels going up and real estate prices remaining stagnant for 10 years is the ultimate chemistry for real estate to start working. I think government bringing down the stamp duty, at least Bombay, I'm seeing action. I mean, you do channel checks and you talk to brokers, you see even luxury properties movement is happening. So I think some amount of stuff will also happen on the real estate side. So it'll all be linked, one thing start working, the other thing start working. If real estate in general starts doing well, it has a huge positive impact on the overall economy. So let's see how it goes.
Rajesh,
Just to go back on that point, Ashish, that you talked about the right chemistry in terms of real estate. I thought the mathematic is more about, what is the EMI you bear versus the rent for original demand to come up. Absolutely. And that equation, considering that real estate prices have still not come down sharply, continues to be very unfavorable from a buyer's perspective. Would you agree?
Mahalakshmi, partially agree, because if you really go out today in the market and you sit, as they say, with cash on the table. Actually, it's not cash; it's check on the table. You see, even in the last 6 months, you can see a 10% decline. And if you want to see the price per se, I think from 2013 end or 2014 to 2020, it has been stagnant. Right. So there was a 10x run up from 2003 to 2013, but from 2013, so if you do a CAGR, a 17-year CAGR, you come down to 7-8%, which is the long-term real estate return. So now if you see the difference between mortgage, I mean a reasonable mortgage is 6.5 and rental is say 3, you need a 3.5% capital appreciation to plug that
Right.
gap. This
Right.
gap, what I'm trying to say, is the narrowest in the last 10-15 years. The
3%
ingredients actually.
rental is rent. I mean, is average rental yield. I mean, I know real estate is a very granular market. You have to look at market by market, but even 3%
Yeah, absolutely.
looks a little steep to me.
After the price correction, Mahalakshmi, no. There would be areas, if you go to mature markets, where there's hardly any development happening and only end use buyers are going. Let's say, to take an analogy, Bandra West in Bombay. You could get 2.5, but the range is 2.5 to 3.5. But if you go somewhere to a close proximity to BKC, you could get up to 3.754. So obviously it is granular, but there are pockets. It's like equities, right? I mean, equities
Right.
also is granular. It's just that you have to pick the sector, pick the stock. Same thing operates in real estate. It will not be, you can't paint the entire thing with the same brush.
So you would say we are in, in a territory from where demand
Real
can
estate,
get hurt.
yes. My view is that we are seeing bottoming out of real estate, and you may see pick up from here, because in the last 2 months, the kind of activity which we are seeing, I have not seen in the last 5-6 years.
Sure. Rajesh, you want to come in on that?
Yeah, I was just going to say.
So he's absolutely right. Last 3 to 6 months, at least in low-cost housing and mid-income housing, because of all the factors, low interest rates, low loan rates, and also prices having been calibrated by many, at least for the new projects, has seen an uptake in demand. I'll give you a small example. A place like Thana, Bhivandi, new project of Dosti, 1,800 flats. In 1 month, he sold 60%. 1 month, but the ticket size of each flat was 25 lakhs, right? So you are seeing, some pent-up demand coming back because of low rates, because of the very fact that prices have corrected. And if you sit across the table with developers, you're getting deals. Even on the luxury side, a lot of pent-up demand has suddenly come about where people are finding better deals and they're sitting across the table and getting 20-30% off from the original rates and doing transactions. Mm-hmm. So it's one area where many changes happened over the last 3-4 years, right from RERA to GST to NBFC crisis to developer crisis. And now with the most, you are seeing some consolidation. You are aware of which builder has survived, will not go belly up, someone who will at least execute and deliver. Wherever there is a RERA number, you are seeing demand come back. On the fund side also, we are noticing a big trend because we run real estate funds. Earlier, the stress was with developers. Now the stress actually has moved to the lenders. So banks and NBFCs are approaching us to take over projects because they want to get that loan off their balance sheet. And they're willing to take a haircut and give it to you at 40%, 50% kind of discount. So we are finding another opportunity from a fund perspective. We've just gone ahead and launched another real estate fund because we are doing these deals from financial institutions where you can bring in a good credible developer. You're getting a deal at 50-60% haircut from today's prices, and you can still offer very good returns to clients. So on both sides, I see. And lastly, on the stock exchange reality index, if you just go 2-3 months back, was actually one of the best performing indices for the last 6-12 months. Clearly, because of consolidation happening with more, solvent players with more, larger scale aspirations of only focusing on real estate. So in all these 3 places, we are seeing positive trend.
If I can just share my 2 bits on it, for whatever it's worth. So if you see, there is very serious foreign money which is coming into the big real estate projects. You've seen the kind of money Brookfield has put into India, Blackstone has put into India. Almost every 15 to 20 days, there is an announcement of one of the big foreign players coming and picking up a chunk of land or REITs or, assets. So I feel that the cost of financing for the bigger guys and builders will come down significantly. The REIT structure has kicked off. So you had Embassy REIT, which was successful. That was followed again by Mindspace. Now we are aware of many such people who are working on similar structures. So one is that there is very serious international capital which is looking at investing in Indian real estate. and those deals you will see money continue to come in. So suddenly there's a source of funding which is coming. So a lot of activity will be there in that area. Now, if you leave certain pockets of Bombay, rest of India, there has already been a correction, whether it's Gurgaon, whether it's Bangalore, whether it's Hyderabad, whether it's Chennai, already a correction has taken place. And where you're getting good deals is where there is a builder or a developer. Then you can sit across a table and negotiate a deal and then do the deal. Even what the Maharashtra government has done, in terms of tax, like bringing the stamp duty down, we think is a fairly good move. So with interest rates coming down, I think what Ashish and Rajesh has said, we see a lot of money moving here. Other thing is, anecdotally, clients are a bit disillusioned with the fixed income market. So I find some of them again going back into real estate, out there, because the kind of volatility we've seen in fixed income markets in the last 2 years. So a lot of investors who came back to because of financialization of the economy, some of them I again find them going back there. But those who are in trouble, I think for them the story is not going to be good, because there is nobody who's here to bail you out and take a distressed project and all, So I mean, of course, recently Edelweiss raised a distressed debt fund, Everstone has raised a distressed debt fund. So overall, I think this sector should do well. Like Ashish said, my personal sense, I mean, as Julius, where we don't cover real estate in India, globally we do a lot of real estate products. But in India, I personally feel that you will see a recovery coming into this sector. And mainly this interest rate is a big trigger. It's really a big trigger. I mean, today a common man can go and borrow money at sub 7. So it's not available to an Ashish or a Rajesh, Today, even if anyone walks across, like I had an employee of mine who recently came to me and said he's looking at buying a house. And he said he's getting a loan at 690, which I think is a very, very attractive rate. Like Ashish mentioned, I didn't realize we are back to 2007 levels. So thank you for that.
Yeah, 675. Today in the papers, I saw 675 somebody's.
Yeah. Plus there are some tax benefits which are available and all that, Mahalakshmi, the area you're looking at buying in must be really premium, So that's the challenge. So the joke is...
to tell you the truth, I mean, where I am living, prices have not come down. This is Hiranandani.
Where do you stay? Okay.
Hiranandani Thane. Prices have not come down at all.
So my sense is that if you want to buy Mount Mary, where there's collector's land and NOC, I mean, you will have to pay a premium. But generally, there is a sense, that there is a correction. I mean, that's a general sense. But will a real estate boom come and all? Difficult to say. I mean, that's difficult to say. But so if you see four-wheelers, pickup has been very good. If you see this festive season, two-wheelers, pickup has not been so much. So jury will be out. But generally, I think numbers may positively surprise us, unless like something extenuating happens. But on valuations, I agree with Ashish that it has run up very sharply. So tactically, we have booked profits. What he's saying is absolutely right. The market has doubled actually. If you see, the market has doubled in a span of 6 months. So there we have done some profit taking, but generally we are still invest on declines. And now we have REIT as a category. So whether it's, I mean, it's not solicitation, but Embassy REIT, Mindspace, IndiGrid, these are the kind of products now which are also there in client financial portfolios, which was not there 12 to 18 months ago or 24 months ago.
But are we underplaying the impact of an contracting economy, job losses, the fact that you will have a new work from home, so that the part which was really doing well was the commercial, right? Yeah. I mean, that is where all the money. But now suddenly even there we are talking of, people working out of home. So structurally the things are not really going well for that real estate. So
the guys who are on the ground are Ashish and Rajesh. Maybe on commercial, I mean, of course, Rajesh has seen a lot of pain also, their promoters also invested in real estate. So I mean, Rajesh understands that more than anybody else, So maybe Rajesh and Ashish are better placed to comment on that.
So, real estate, work from home has both positives and negatives. One, of course, if it's going to be a reality going forward, many people want to get a little bit of space and have maybe a slightly bigger house as compared to where they were staying. Because even today we notice while doing virtual calls, some children running past or sound of a cooker going off, etc., etc. So there is this need that if the world tomorrow going forward will have a hybrid model in many cases. You're aware, Standard Chartered first institution, yesterday I heard the announcement that going forward, irrespective of COVID, this hybrid model is now come into place. So
Right.
what has happened to commercial? On the commercial side, number one, because of this requirement, this COVID thing not going away for at least a year and a half, sometimes even the space requirement is larger. Number two, there are one industry goes through a challenge, there's another industry that comes up, which has requirements. Suddenly foreign funds coming in, buying into real estate, they need offices. Suddenly you have, the e-commerce platforms, they're expanding at such a big pace, they need offices. So it gets covered up, and it's a function. Commercial is a lot on supply, demand, location, which area, how much, supply demand there is. So we see commercial continuing to do well. Okay. It's not going to go away. There are many markets where there's hardly been any supply over the last 6-7 years. There are certain markets where there's too much of supply, and their prices will remain, depressed. But there too, A quality, AAA quality buildings still command good tenants, and that those businesses are growing. And frankly, in India, even with tech guys, when we speak to, while they've told their people to sort of work out of home, but the new business that they are getting in is so dramatic in the tech space that they're actually hiring in big numbers. The hiring will start another 3 months, 6 months. You'll see many of these guys back to hiring in a big way. So once again, the requirement will be there, because in India, someone who's earning 20,000, 30,000 still is not living in the best conditions at home to do work effectively. So it's not like the US or something else where everyone has a hygiene standard of living. Today in India, that's still a challenge. So we continue to see good potential on both sides, residential and commercial. And with all the reforms that have come into real estate, all the developers, either who are over leveraged are gone. They've gone belly up. They'll sell their businesses. They'll sell their projects. They'll take a haircut and get out. But all the serious players will actually benefit, and they're benefiting even today. So that's what we are seeing from or hearing in the industry.
Desperation has not yet come in yet, because the inventory level continues to be the highest in all the major metro markets. I mean, we have been talking of this, the final tipping point. Now, this is the worst. I mean, how much more? I mean, is that this? I mean, what is delaying that whole collapse in price? I mean, like he said, that he's got a 30% discount. Can you generalize that and say that's what it is across all of this? Then the inventory should have been over quite quickly by then.
It's not going to be over that easily. Residential, there's a lot of supply that had come in various pockets. Also, your economy has gone through 2 or 3 years of challenge that creates uncertainty in the minds of people who are home buyers. So people want things to stabilize before they start making the purchase. Today, maybe last 6 months has given them an opportunity because of low cost of funds, and generally some places where discounts are happening. But you will see over the next 1 or 2 years this inventory getting absorbed, especially of the projects that have been completed, or where you have more surety that the project will get completed. There's no doubt in my mind.
Isha, people have lost faith in a under construction project.
Yeah.
So they are afraid to buy. Like when I talk to builders, like if you see Viveria, like Ravira Hijaz group, I don't know what they continue to sell, because there the investor is assured that he will get his delivery. So the challenge, why in my I'm telling you my gut based on my conversation, and like I said, we are not in the business of real estate in India, but the challenge is that people have lost faith in underdevelopment. So they say, you get the building ready, you're ready to deliver, then we are willing to purchase the flat. So the view is not bullish, but it is much better than what it was 12 or 18 months ago, because out of 100, 99 builders had gone out of business, right? So I mean, it has never been so bad for real estate industry. Of course, Edelweiss knows it better than anybody else. I think Ashish can comment best on this. He's at the heart of the storm.
I just wanted to add some insight to it on the real estate. Again, Deutsche Bank, as Ashish said, Julius Baer doesn't. We also don't advise clients on real estate as such. But certain insights that we get from the lending side of a book, right? We get clients on the banking side and the lending side. And one, I want to reinforce what Rajesh has said on promoter developers who are good promoter developers and settle. They are giving us a kind of an insight that the market is started to grow. In a sense, their MNC clients are booking more space, and they continue to add square feet to it, on development. So that's one area where we've seen, because we are generally there with the top end developers only as promoter developers on the lending side. And we feel that positioning, they are doing extremely well. The question that normally that I ask them is why there are a lot of people who are going belly up, like Rajesh said, but they are not being supplemented or taken over by these uh, developers. And why are they not doing it? Because if it's coming so cheap. So
Right.
they feel the pricing is still not right, in the sense that debt amounts are so high still to take over, it's still not worth. So that's the second insight I would just like to add to the group. And this has to narrow down to an extent that it becomes really profitable or really good for them. But Rajesh is feeling the real process where he's saying a lot of people are coming to them in the fund, and also that is reality. What I'm saying is that insight that these developers are waiting for a certain little better equation for them to really plunge in and take over. So that's the second. Third is, I believe this micro markets have started picking up, especially on the commercial side. On the commercial side, it's very clear because we see a lot of our HNI clients going directly into it and actually sniffing for deals which are very economical for them at this point of time. So they get it like a haircut. So they're looking for that. So that's a third insight. So I think real estate, while I don't see it really coming up to a level where it can be a secular movement on real estate, and people as an investor you can look at it, but there are opportunities coming up with good developers like Embassy and Voyagers and all coming up in REIT, so investors could look at it. So from a wealth management client point of view, REITs are a good bet, a debt or a debt plus. So I think that's what is important for us, for our kind of clients.
Yeah, Ashish, how bullish are you
He can have the last word.
On REIT?
on real estate? Yeah.
So it has to be looked
I've
at
seen
in.
a couple of developers also being dragged to the bankruptcy court.
So all that leads to bottom of the cycle is what we feel. See, the worse the sector gets, the more upside it can bring to the table. See, the way you have to look at it, Keshav, is just look at all the asset classes right now. Okay, you invest in debt, what will you get? You invest in equity at these valuations, what will you get? You invest in a completed project at a discount, good deal in real estate, what will you get? And then you can take a call in terms of comparable returns which one can make. And I would also agree that the REIT as a particular category, obviously there is an overhang of what is going to happen to commercial real estate and all, and I think it's really too early to make a judgment that commercial is gone and work from home will take over. Human being is a social animal. I mean, you cannot continue to operate from home, and there are multiple factors which will come to play. Call center executives, and these are real life examples, they don't have equipment or the infrastructure in their residence to be able to conduct their businesses. uh, there are data privacy issues which BPO employees have to face. So these are not easy answers. So we look at certain white collared segments. We are not the population who consume the commercial real estate in bulk. There are other categories. So there are arguments on both sides, and there is offtake happening. I mean, I was really surprised how Embassy REIT and Mindspace have held on to their prices. Obviously Embassy had gone 400 plus, has come down to that. 400 plus was giving a yield of 3.5, 4%, which was unreasonable. Now it's come down to a level where it is giving a reasonable yield of about 6%, but it's holding on. Their rental collections are more than 95, 97%. So we'll have to see how commercial plays out, and commercial to my mind is always an alternative to fixed income, because the yields are around 6-7%. If they go up very high, the end user can actually borrow and put his own space. So the rental yields in commercial will always hover around fixed income yields, and therefore the upside from capital appreciation will be muted. Residential behaves in a different manner. Residential is like equity, right? There are periods where you will go through lull, and when you see upside, you get an upside. So I'm not saying that you will see what you saw between 2003 to 2010. Don't get me wrong. I mean, under no circumstance is where we are, but I'm also not seeing what we saw from 2013 to 2020. I don't see that 7 years from now, real estate will underperform debt, where debt for a 7-year period will not give you more than 4.5%, 5%. Right? Because in debt, our customers unfortunately tend to look at what is the past 6 month and 1 year returns, whereas that doesn't count. You have to see what will you make going forward from here. And if we say that, another year or so, we are going to be in a recessionary or a reflationary zone where debt will give returns because interest rates will go down. Thereafter, if they start picking up, just 4-5 year return from debt will not be very attractive from here. And that's our view. In that context, you have to see where does real estate fit in. Unfortunately, there are not too many financial products right now because of the way the sector has behaved over the last few years. So clients are not able to participate. So they have to go and take end units, which most of us don't operate in.
That sort of, you just led to the next question, which is, how is debt looking? Because one, the interest rates have been very, very favorable. Last 1 year, it's been just going down. In fact, for the last few years, it's been just going down. Now we have almost, I don't know if we have hit the bottom, but I would like to think we have already hit the bottom. Second, there is COVID-related stress, which of course all the banks are now taking separate provisions for COVID-related stress, etc. But is the worst really over in terms of defaults and asset quality and stuff like that? So therefore, what would be the outlook for debt funds be over the next 1 year?
You want me to answer?
Yeah, sure.
So I see AAA debt funds. I think there's hardly anything left on the table. People can add. I have not seen these kind of returns in my wealth management working life, so to speak. People have unfortunately started adding duration willy-nilly because the short end of the curve has, gotten so suppressed and the term spread has widened. And the term spread is really wide right now that people unknowingly are taking a duration risk. They are taking 7 year, 8 year, 9 year, 10 year products because even on a 1, 2, 3 month period, it's showing a reasonable MTM. But it turns at a point in time, it turns. So one needs to be quick to book profits there because once the cycle turns, it will give a significant amount of pain. Unless somebody is holding a roll down product, something like a 10 year roll down, 8 year roll down, that's fine. That's okay. That's like a FMP. You will make what you've entered with. You have to ignore the mark to market implications in the interim. But if you're in an open-ended fund and you're going into duration, I think on a temporary basis, 3 months, 6 months, 9 months, you may still make money. But then you should be quick to move back because when the cycle turns, you will see negative returns. There are some pockets, although it's a controversial one, but there are some pockets which are emerging in credit funds where we feel value could emerge. But again, with a pinch of salt, people who can take on losses, volatility should go into it, because I don't want a situation where clients, because of absence of yield, start taking undue risk. Right. Because debt is supposed to give you your capital and interest back. One should not unnecessarily take that 25-50 basis points extra and risk the whole capital, but there may be some pockets which could emerge and some part of the allocation could go there. REITs have already been spoken about. I think they are obviously, if commercial goes through a disaster, they will have an impact, but if it stays the way it is, I think it is one of the best places to be right now. There is only one InvIT asset in India which has given stellar returns. I think it bottomed at 85. Right now the price of IndiGrid is 110. Plus it has given a 12% annual distribution. So it has given stellar returns. I think more such assets will come into play. One area which could emerge for ultra HNIs, which we'll see activity, not seen success till now, is low volatility long short funds. I think some of the specialist players are coming out in the market. I think that's some place which one could see. So broadly, these are the few opportunities in debt. Unfortunately, not too much in terms of yield, but when inflation is where it is, I don't think you can expect the nominal returns to be very high.
Sure. Anybody has a different view on debt in terms of is there more pain and where will interest rates get?
Okay, from Deutsche Bank's view, basically, for us, clients are very conservative, and a pool of clients that we have, we've been very cautious on the debt side. We think the markets still have a lot of bleeding possibilities, and therefore you need to look for areas which will swarm up a lot of credit risk. The kind of books and the bans that are going on, we see it on the bank side also. You see the kind of facility the government is extending, the moratorium and the EGS and all that special credit schemes that have come in. We think it's yet the NPAs are getting postponed, and restructuring and all that will not be seen in the real figures for some time. And those figures, you'll only know the clear data will come in maybe after a year or so, maybe 9 months to 1 year. Having said that, we think therefore it will take time. Either within that time, they'll be able to redo the BICs and the demand picks up, and therefore the companies or the individuals are able to get their businesses back on trail. So that 1 year could be used for that. But if the risk is that the demand doesn't pick up and it's sluggish in this period, then you might see more bleeding in that area. Having said that, whether it will impact the medium to large size companies or not, yes, it will. That's what our reading is. And therefore, you need to be very clear where you're investing in the debt space. So we are clearly positioned for AAA rated, and that also where there's high level of cash and companies. So we're very cautious there. And I think to the second answer, so apart from AAA rated, long short bond funds, some of them have done really well, and those need to be looked at. And I think there's no need to be adventurous in this debt space, because we think debt has to give you a stable kind of a return. And if you want to take a little bit of a risk more, you should go into equities and not take an equity risk in a debt portfolio. So clearly, equities have its own place. Go by a structured allocation, strategic asset allocation, and just go by what you have been doing all through. A little bit of changes can happen plus 5-10% across asset classes, but I think that's good enough. And I think if generally there's a secular movement upward and there's a positive movement upward, you would see first the equity markets rallying, then you will see the real estate, you'll see REITs, everything doing well, and then you will see this, the interest rates spiking up because of inflation and other reasons, and then you will start seeing the debt returns really going up. So I think we need to marry with a lower debt return, which could be just 5% plus, around that figure for the next few years. Maybe at least visibility is there for a year or two.
Okay.
And that the client should be happy with, because the rates of return on deposits, because the liquidity and all will be very low. As everyone said, it's clear. The deposit rates are very low, the interest rates on loans are very low, and they're going to come down further, because we think the inflation which is there on the reasons of foods prices and all, that's not going to sustain for too long. We think the supply side constraints are there at the moment, and therefore the rates are spiking. But I think there's no way the governments can afford, the monetary policy can afford actually to increase rates soon. It may not go down the hill, like you said, for too much now, because it's come to some kind of a bottom figure. It may sustain itself for a little longer period. Sure. And the increase may not happen.
Sure. Rajesh, would you think debt is the worst is over in terms of credit risk, or is there possibility of earning higher yields by slightly increasing your risk profile of your portfolio?
So government borrowing pretty much has stayed within limits, and also RBI measures that they've taken have eased the benchmark rates and have kept various spreads range bound. But we still find that there is some play in duration for a 3 to 5 year tenor, both in GSEC, AAA, and a little bit even on the credit side in AA. You're getting some really good businesses, because we also monitor them on the equity side, which are rated AA, but the yields are very good there. So there is a little bit of play on credit where we believe it will come down over a period of time, and mid-term duration in both G6 and AAA. So and good MLDs are also available, market-linked debentures today of some of these good quality AA, AAA names which are more tax efficient, and they are a good play on fixed income. REITs continue to be a good play on fixed income. So just keeping these 3 or 4 areas in mind, and whatever risk has to be taken, that goes into the equity side. So not take too much of risks on fixed income, but clearly a duration and credit play. In the shorter, I would say mid-term range, 3 to 5 year, there's good. We believe that the pressure in second half will ease further, and there is a good play there.
One last question to you, Ashish. Since you mentioned value investing, one real dichotomy that I've observed in the value segment is the contrasting way in which the debt and equity of PSUs have been priced. So, I mean, the equity dividend yields are in many cases double or triple of the money at which they are going for in the bond market. So, is there a real reason or rationale why you would justify this, or is it something for the taking?
So see, what was happening is the government was continuing to supply equity by doing these ETFs. So there was constant supply of equity from the PSU side. So they've done 3 moves, recently, which I think are very positive. Number one, they have, I read this in the newspapers, and then Prashant Jain also briefly mentioned this to me that, he's also heard the same thing. The government has said that they will no longer be doing dilution through ETFs, so there's no perennial supply. Now, I haven't got this cleared. Maybe you can check from your sources, Keshav, if this is correct, So I think first is the supplies. See, why have some of these consumer stocks and all run up? Because there's so much demand and there's not enough supply of these stocks. Right? So first is the supply side has been addressed, out there. The second part is, I think, if even 1 or 2 genuine divestments happen. So far, we've had divestments, but one PSU buying another PSU, or those kind of investments. So if BPCL actually gets sold, it will give a lot of comfort to the investors that the government's intent is actually to get out of the business of not being in all the businesses out there. And third thing, like you said, is that if the supply side constraint stops, the government is really serious on on divestment, then I think it will start reflecting in the valuations. And like you said, that what is happening is today an NTPC is able to borrow 3-year money at 5% or whatever, out there. I mean, now that will definitely have an impact on their working. But one of the challenges I've seen in value investing, like I was just now on one of our global calls last week, that this ESG as a theme has become very, very powerful, and we should not ignore it, because Europe, most of the global investors are now very serious about ESG. Like when we were talking about valuations being, there are large caps also. This is not an equity recommendation, but today ITC, please check the dividend yield which ITC has. So a lot of large caps also have a dividend yield. So I think the ESG theme also is impacting some of these PSU, be it Coal India, NTPC, these kind of
power
things.
pack, essentially.
Sorry?
The power pack, essentially. The power.
Yeah, exactly. Now, these are all cash generating businesses doing very well, Power Grid, NTPC, but because of the ESG theme, a lot of big global players are not investing in it, out there. But my gut is that some of these businesses should start doing well because the government has got good intents. The moment it starts reflecting, I think we should see those valuations improving slightly. Is it a pure bull trade and you should get into it? No, you have to be more diversified in it. And when I said value investing, I meant, not necessarily just value. Like, there are businesses which continue to compound at a decent rate, which have been ignored by the market, like Power Grid. Power Grid is a very stable return business, where, so those are the areas, some of the money may possibly move into.
Sure. Can you expand on those pockets of value that you find?
See, right now it's mainly in public sectors. If you see, it's public sector enterprises and maybe some of the stocks impacted by ESG. Like, for example, if you see ITC has a huge consumer business. It's a huge, if my personal gut is if ITC the stock is split, the consumer business may get a very high significant, get a very, very significant valuation. And similarly, banks, you have banks at one time price to book. ICICI Bank, Ashish is ICICI Bank, 1.3 times price to book. So I see a lot of value across sectors. A lot of mid-size banks are trading at fairly decent valuations. You have tech companies again in the mid-size which are value. You have auto ancillary businesses which are at good valuation out there. So it has to be a more broad-based rally. Right now you had these 7, 8, 9 stocks which were going up. I think if that becomes more broad-based, then you should see some of these other sectors moving up. In debt, my view is that for the segment we are advising in, a lot of pain is out, because predominantly we work with mutual funds and the AAA corporates, and also most of the pain I feel is out in the segment where we are working in, and we have started selectively recommending some credit funds to our clients also. The main problem in debt is that the interest income is taxed at marginal rate. So even if you're innovative, if you're a high net worth, you'll end up paying 43% tax. Okay, so you're a bit of innovation also. Like if you do a long short fund in debt, it pays 43% tax. So the main challenge is the tax rate, in fixed income. So there's not much space to innovate. Clients in India will have to get used to lower returns. In every meeting I try and explain that to them. Look at, today an investor in Europe, actually in certain jurisdictions, Nestle bond trades at a discount. I mean, you have to pay money to buy a 10-year Nestle bond, out there. So we'll have to get used to lower returns. That's what I think.
That's all the questions for me. Keshav, you have anything else to ask?
Maybe we could just kind of, have an outlook question from all of you. I mean, how do you see
what to expect in terms of returns over the next 1 year?
2021, yeah.
Rajesh?
So
the risks,
Ashish,
downsides both.
There is two things. One is excess liquidity. Second is lower returns on fixed income. So you are going to see money coming into equities. There's also optically market seeming high, but there's huge value still available. Financials, for example, maximum value available. People are still concerned about NPAs and loans and whether moratorium, how much of it will be recoverable, etc. But on a month-on-month basis, you're seeing improvement. So financials, which includes insurance, AMC, NBFCs, private banks, good value available, agri-related businesses, good value, auto. So there's a lot of value, and hence equities, in our opinion, will, while if you look at on a year-on-year basis from last year, the index has probably moved or come back to pre-COVID levels, but broad returns have hardly been 5% and 6% in equity and not beyond that. I think easily double-digit returns in equities one can assume. Not the index, I'm not talking about index, but in a well-managed portfolio, your returns can be up double-digit and above. And if the government puts in place or goes slightly more aggressive in other major reforms, pending reforms, this can even improve better. I don't see COVID as a very big risk anymore. I think it's being managed, keeping aside the fact that there will be short-term interruptions that may continue. I think there's a clear realization that you can't shut back the economy completely again. So, with vaccine, with everything else, that also will be an improvement going forward, and it'll augur well for equity markets. Fixed income, you're going to stick with your 4 to 7% kind of return without risk, and maybe some high yield debt one can add. We also believe that gold as an asset class now is an important aspect. We have been overweight on gold for the last 1 year, but even on a long-term basis, 4-year, 5-year, given that today your GDP, global GDP is $90 trillion and you have debt of $270 trillion. Plus, I told you that amount of money that's got printed, you will have a situation where money will move into hard asset classes, gold, distressed real estate, equities. So gold also is an important part of asset allocation, and we believe that it'll give you fixed income kind of returns. Maybe if you're lucky, slightly better, and it should be a key part of the portfolio.
So, Keshav, what I did is I thought I'll hold Unmesh to this. He's our product head. So best he gives a prediction, and then I can next year look at his appraisal with this. So basically, he's saying 12 to 14% equity, 5 to 7% debt, 13 to 15% alternatives. Is what our product guys feel. On gold, we have hourly tracking. Because Julius, where gold is like a big asset class. I was just talking to one of my colleagues in Japan, and one of his clients just bought 100 million worth of gold, and he custodized it with us. So basically, our current call is to buy gold on dips. We think the meat of the rally is over, and we feel that gold is buy on dips right now. We are correct. We feel that clients should continue to diversify overseas, and international portfolio should be a significant part of your. It should at least be 10 to 15% of your asset allocation, and US and China is what we like.
Sorry, just to add that part I missed out. International is also a key part of our allocation. Both US and China. We have a global fund for the last 3 years, and we are also bullish on China since the last 1 year. And we believe 10% of our client portfolios we've been putting in international equities, and we'll continue to do that.
So is that an issue? And in terms of valuations, are you comfortable with where the global, especially the US equities are in terms of valuations?
Yeah, so we have a very strong portfolio manager in the US, and we run it like a PMS. So there are 20 stocks, and of course they have their own filters on earnings growth, cash flows. So we are very, very comfortable despite the run up. It's not only a tech oriented fund. It has a combination of some of the biggest brands, be it in FMCG, be it in consulting, be it in IT, and pure play product tech companies, and very, very comfortable on a long-term basis. See, for us, some of these aberrations that happen in the short term because of COVID or something else, we still believe in the power of compounding. Our philosophy is not to book short-term profits and get people in and out. And even if you're in good businesses, even if you get the timing wrong and you have a long-term horizon, the probability comes in your favor. So it's all about how much time you spend rather than trying to time it because of election or something else. So we continue to remain bullish on America and China being the two largest consumers, even in the next 5-10 years. And your client portfolios can't not be exposed to some of the best businesses that will benefit from it.
Yeah, for us, it is, as Ashish and Rajesh both have said, I think the returns that you can expect from these asset classes on equities, we're saying around 12 to 14. Fixed income can't really go beyond 5 to 6 or so. Gold is one focus that our house view is also very positive on. It's been positive for the last 1 year. And till September 2010, the reading is it should cross 2,100 per ounce. So that would be around 7 to 9% additional kind of a return there. And the alternatives should give you around 15 to 20. Otherwise, you don't need to get into alternative. So our suggestion to the clients would be stick to strategic asset allocation. If you're either a conservative, balanced, or a variation of in and around that, and aggressive, and be very clear, even the aggressive, like you have an equity portfolio, then be more on the large, like we would say 35% on large, and then around 20% on mid cap, out of the 55% that you have. So even there, we can make some classification on what, but we are more large cap focused. We feel the businesses which are run well in India, which have strong management, which have strong balance sheet, they will continue to do well. Even if their PE levels are high, you can still make money there. So our NDPMS and DPM that we've launched recently, they all are basking on mainly large cap and less of mid cap. And we still feel a lot of the mid cap stories will ultimately turn to become large cap. So you need to spot them well. And those are the ones which we're looking for. And if you have a proper stock selection this way, in a long-term basis, if you're looking long-term, you'll get your premium on equities that you're looking out for. And that's what you need to be focused on, very long-term, and not really doing trading on a short-term basis and expect returns to average out over a period of time. So that's what we are saying. And gold is globally, we think uncertainties are going to remain, at least in the visible time period of 3 years or so. And then gold, as any other commodities, would still be an interesting asset class to invest in. So that's broadly the picture. I think clients should stick to discipline, and our job is mainly to partner with them to see that they don't really stray too much on their strategic asset allocation.
Deutsche Bank stock, what's your call, Atin? Deutsche Bank stock, should we buy or not? What's your suggestion? European stock.
Deutsche Bank?
Deutsche Bank stock. What's your view on Deutsche Bank?
Yes, the Deutsche Bank stock is also looking forward. If you've seen the Moody ratings have changed, they've moved from negative to stable, just announced, and the stock has also moved up. So hopefully they at least crossed for the first time the European peers.
Yeah, Ashish.
I'm saying I always find it difficult to give a 1 year projected return, especially on equities. So debt, my view would be fairly consistent with most, that if you stick to the quality end of the curve, then it would be somewhere around 4 to 6%. if you are able to do some bit of duration, add some MLDs, market linked debentures, and REITs and InvITs, then you can see 100 basis points alpha over that. Equity is very frankly very difficult to say what will be the 1 year projected return. So what we typically tell clients is continue to maintain your asset allocation. And I think what Rajesh also pointed out, that it is actually time in the market. Like you will keep hearing, stories that if you miss the 10 best days, 70-80% of the returns are gone. Actually, what happens is that those 10 best days actually come after the 10 worst days, and people actually cash out after the 10 worst days. So, and it's empirically proven. I mean, this time I witnessed the correction so closely that we did a bit of a study on tail risk and all this. So we just want to maintain asset allocation. When valuations will run up, we'll moderate it or dial it slightly down, but broadly stick to asset allocation. Gold, we have started adding to the portfolios about 6-8 months back. We should have started long back. Our theory on gold is very simple, that there is a rupee depreciation meter which keeps running, and give or take, if the global interest rates are at 0 and we are at, let's say, 4, 5, 6%, give or take 3-4% of depreciation, you're anyways going to see over a 10-year period. And add to that whatever little appreciation you want on gold, you will start beating debt meaningfully over a 10-year period. And despite the fact that gold has not performed from 13 to 15, the only thing you have to be careful about is that don't take a very, very short-term view. Either you're a trader on gold, then you're a professional investor. It's a separate fact. Go with a 10-year outlook. Your 7-8% is because of the rupee depreciation and movement in gold is baked in. International asset allocation, I would again tend to agree, US and China, because these are the two markets which are providing you not only with the consumers, but also some of the finest companies in the world. And unfortunately, there is no other way to get access to those companies. Alternatives, I am not so bullish. I mean, the lowest I heard was, 14 to 18%. I don't think alternatives are giving these kind of returns these days. Post-tax, post-expenses, 10-11% is what ultimately the clients end up getting. But if you look at fixed income at 4%, that's still a 700 basis points gap. But one needs to be careful. It cannot be, debt real estate funds where the builders are caught up and all that stuff. So if you're in private equity or some specialized space, it will give you reasonable amount of returns. But overall, what we want to do is maintain the strategic asset allocation of the clients with tactical bends as and when market gives you those opportunities.
Okay, guys, thank you for taking time out, and wish you all happy Diwali and hope to meet in person the next year. Thank you.
Thank you all.
Thank you, everybody. Happy Diwali.
See you guys. Happy Diwali to all of you.
Bye-bye.
Take care.
Bye.